On Thursday, U.S. stock markets experienced a robust performance, with the S&P 500 and Nasdaq Composite closing at record highs, bolstered by significant gains in technology stocks and cryptocurrencies. Nvidia, a leader in AI chip manufacturing, achieved a historic milestone by surpassing a $4 trillion market capitalization, becoming the first public company to reach this valuation. Concurrently, Bitcoin surged past $113,000, setting a new all-time high and reflecting a strong risk-on sentiment among investors, despite geopolitical tensions such as President Trump's renewed tariff threats against Brazil and other PRICS nations. The Dow Jones Industrial Average also rose by approximately 0.4%. In the broader economic landscape, the U.S. Department of Defense announced a $400 million investment in MP Materials, a rare earths miner, highlighting strategic efforts to reduce U.S. dependency on Chinese imports and address supply chain vulnerabilities, particularly amid ongoing U.S.-China trade tensions. This move underscores the importance of securing rare earth supply chains crucial for both civilian and military applications. In corporate developments, Delta Air Lines reported positive second-quarter earnings, revising its outlook upward and boosting its stock by 12%. This optimism is attributed to increasing clarity in trade negotiations with major partners like the EU and India. Meanwhile, the labor market presented mixed signals, with jobless claims unexpectedly falling to 227,000, complicating the Federal Reserve's interest rate decisions. Investors are closely monitoring these developments, with a significant probability that the Fed will keep rates unchanged in the upcoming July meeting.
Chancellor Rachel Reeves is set to announce a permanent government-backed mortgage guarantee scheme, allowing first-time buyers and home movers to purchase homes with just a 5% deposit. This initiative, part of the Labour Party's Freedom to Buy scheme, aims to sustain the availability of 91% to 95% loan-to-value mortgages by providing lenders with a government-backed safety net. The scheme, which will be detailed in Reeves' Mansion House speech, is designed to support homebuyers with smaller deposits across the UK, replacing a similar program by the previous Conservative government that ended in June. The new scheme includes a government guarantee that insures lenders against part of their potential losses, with guarantees valid for up to 7 years post-mortgage origination. Lenders will pay a fee to Home Treasury for each mortgage under the scheme, with the expectation that these fees will cover any claims against the guarantee. However, concerns remain about the affordability of repayments on these high loan-to-value mortgages. Critics, such as Rob Houghton of Really Moving, argue that while the scheme addresses the deposit barrier, it leaves buyers with substantial mortgages to service, potentially exacerbating affordability issues without a significant increase in housing supply.
Nvidia has made history by becoming the first company to reach a market valuation of $4 trillion. Driven by the burgeoning demand for artificial intelligence AI technologies. The California-based chipmaker's ascent underscores Wall Street's strong belief in AI's transformative potential across various sectors, from robotics to automation. Nvidia's market capitalization now surpasses the GDP of major countries like France, Britain, and India, highlighting investor confidence in its leadership in the AI space. This surge is also contributing to a broader recovery in the stock market, with Nvidia's performance outpacing major indices such as the Nasdaq. The company's recent advancements, including its next-generation Blackwell technology and innovations in real-time digital twins, have solidified its position at the forefront of AI development. Despite challenges such as U.S. export controls to China and competition from emerging players like China's DeepSeek, Nvidia continues to report strong earnings, with nearly $19 billion in the latest quarter. The AI race remains highly competitive, with tech giants like Microsoft, Google, Amazon, and Meta vying for dominance. Yet Nvidia's strategic investments and technological breakthroughs have kept it ahead, as evidenced by a recent UBS survey showing the company widening its lead over rivals. As AI continues to evolve, it is expected to drive significant changes across industries, including potential disruptions in the labor market.
The recent Federal Reserve analysis, informed by PYMNTS intelligence data, highlights the emerging trend of pay by bank as an alternative to traditional card payments. This payment method leverages open banking to facilitate direct bank-to-bank transfers, offering potential cost efficiency and enhanced security. Despite these benefits, the adoption of Pay by Bank remains low, with only 6.4% of consumers currently using it, though there is a notable interest from 40% of consumers. The analysis points out that consumer skepticism, lack of spending rewards, and ambiguities in fraud liability are significant barriers to wider adoption. However, incentives such as cashback discounts and loyalty benefits have shown promise in increasing consumer interest by 72%. The Fed's endorsement of PYMNTS findings underscores the transformative potential of Pay by Bank, particularly in sectors like retail and grocery where ease of use is crucial. The analysis suggests that younger demographics, such as Gen Z and millennials, along with higher income earners, show a higher willingness to adopt this payment method. This indicates a potential shift in consumer payment behaviors in the U.S., driven by the appeal of real-time fund availability and reduced transaction fees. However, the challenge remains in balancing the cost savings for merchants with the need to offer incentives that can drive adoption without eroding these savings. As open banking continues to evolve, it could redefine commerce by enabling secure direct transactions from consumer bank accounts, though further research is needed to address the existing adoption barriers.
JPMorgan Chase & Company is evaluating a potential reduction in the weighting of major bond issuers, notably China and India, within its GBIM Global Diversified Index. This index is a critical benchmark for local currency debt in emerging markets, influencing over $200 billion in funds. The proposed changes aim to diversify the index by lowering the cap on individual country weights from 10% to 8.5%. Such a move could elevate the average yield of the benchmark, as it would allow countries with higher borrowing costs to gain a larger share, offering potentially greater returns but also heightened risks. While these are preliminary proposals and not guaranteed to be adopted, they reflect JPMorgan's ongoing efforts to adjust its index composition in response to market dynamics and client feedback. The potential rebalancing could significantly impact investment flows, as the index guides many global investment strategies in emerging market debts. If implemented, the adjustments would not only affect China and India but also other prominent bond issuers like Indonesia, Mexico, and Malaysia. Conversely, countries like Brazil, South Africa, Poland, and Colombia might benefit from increased exposure. Additionally, JPMorgan is exploring the introduction of a new frontier local markets index, which would encompass $344 billion of debt across 521 bonds and 21 markets. These developments underscore the evolving landscape of emerging market investments and JPMorgan's strategic maneuvers to align its indices with broader market trends.
Piper Sandler has downgraded Workday, Nasdaq WDAY, from neutral to underweight, reflecting growing concerns over the company's growth prospects amid shifting CIO spending priorities. The price target has been reduced to $235 from $255, as a recent survey indicates that 52% of CIOs expect AI to lead to workforce reductions, up from 39% previously. This trend suggests a potential decline in demand for application software, with per-employee pricing risks adding further pressure on Workday's financial performance. The firm's analysis indicates that Workday may become an AI casualty due to these headcount reductions, highlighting the broader impact of AI on the software sector. In contrast, Oracle, NYSE ORCL, has been upgraded to overweight, with its price target increased to $270 from $190, driven by robust enterprise demand and a favorable spending environment for AI infrastructure. Microsoft, Nasdaq, MSFT also saw a price target boost to $600, as Azure's market share continues to expand with spending intentions exceeding 80% for the first time. This divergence underscores a significant shift in CIO spending towards AI infrastructure, potentially benefiting companies like Oracle and Microsoft while challenging application software providers such as Workday. The evolving landscape suggests that firms heavily reliant on traditional software models may need to adapt their strategies to align with the growing emphasis on AI-driven solutions.
Levi Strauss & Company has revised its full-year sales guidance upwards, reflecting stronger-than-expected financial performance and resilience against tariff pressures. The denim giant, led by CEO Michelle Gass, expects its adjusted earnings per share to range between $1.25 to $1.30, surpassing the previous forecast and analyst expectations. This optimism comes despite the imposition of a 30% tariff on Chinese imports and 10% on other regions, which Levi's has partially absorbed to mitigate price hikes. The company's strategic focus on direct-to-consumer sales and reduced reliance on wholesale channels has bolstered margins and provided deeper customer insights, enhancing profitability even amid tariff challenges. In its fiscal second quarter, Levi's reported earnings of 22 cents per share, significantly beating the 13 cents forecasted by analysts, and a revenue increase to $1.45 billion, up 6% year-over-year. This performance was driven by strong consumer demand, fewer markdowns, and growth in direct sales channels, with notable success in expanding its women's apparel line. Levi's gross margin reached a record 62.6%, attributed to strategic pricing and cost efficiencies. The company's ability to sustain growth amidst global trade uncertainties, particularly with potential tariff increases on key sourcing countries like Bangladesh and Indonesia, underscores its robust market position and strategic agility. As Levi's continues to navigate these challenges, its focus on innovation, premium pricing, and consumer engagement remains central to its growth trajectory.
Flutter Entertainment has solidified its position as the world's largest online gambling operator, boasting a market value exceeding $40 billion and employing over 25,000 individuals globally. The company, which owns prominent brands like Betfair, Paddy Power, PokerStars, and FanDuel, has recently shifted its primary stock market listing to the U.S., maintaining a secondary listing in the UK. The move is part of its ongoing expansion strategy in the lucrative North American market. Despite a slight underperformance in its first quarter results, with revenues at $3.67 billion versus an expected $3.84 billion, Flutter's annual results for 2024-2025 showed a robust 19% revenue increase to $14 billion, and a significant swing to a profit of $162 million from a previous $1.2 billion loss. The broader sports betting sector, however, faces challenges, as fewer states have legalized sports betting than anticipated, contributing to modest stock declines across the industry. Despite these hurdles, Flutter's diverse brand portfolio and strong market presence position it well for future growth, especially with the projected increase in global gambling participation. Potential regulatory changes pose a risk, but the current landscape remains favorable. Investors eyeing Flutter are encouraged by its positive public perception and the sector's resilience in challenging economic conditions, although they must remain vigilant of evolving regulatory environments.
India's continued purchase of Russian crude oil has played a pivotal role in stabilizing global energy prices, according to Petroleum and Natural Gas Minister Hardeep Puri. Speaking at the 9th OPEC International Seminar in Vienna, Puri emphasized that halting Russian oil imports could have driven crude prices to over $120–130 per barrel. With Russia producing over 9 million barrels per day, any disruption could have led to a 10% reduction in global oil supply, causing significant market upheaval. Despite Western sanctions on Russia, India's strategic move to buy discounted Russian oil under a price cap has been crucial in maintaining price stability, Puri argued, countering criticism of India's energy policies. India, the world's third-largest energy consumer, is actively seeking to diversify its energy sources. Minister Puri's meetings with key figures from Kuwait, Nigeria, and Shell underscore India's commitment to strengthening its energy partnerships and exploring new avenues for collaboration. With plans to explore 2.5 lakh square kilometers of new offshore and onshore areas, India is poised to expand its exploration and production (E&P) activities, aiming to increase the share of natural gas in its energy mix from 6% to 15%. These efforts are expected to attract advanced technological partnerships and enhance India's energy security, ensuring a balanced and sustainable energy transition amid geopolitical challenges.
The Dow Jones Industrial Average has recently outperformed the Nasdaq Composite, marking a notable shift in market dynamics. As of July 10, 2025, the Dow rose by 300 points, or 0.7%, nearing its record close of 45,014.04 set in December 2024. In contrast, the Nasdaq Composite inched up by only 0.2%, struggling to maintain its previous momentum. The S&P 500 also saw an increase of 0.4%. This divergence is attributed to the Dow's limited exposure to the tech and communication services sectors, which both experienced a decline of 0.2%. This trend underscores a rotation in investor sentiment, favoring the more traditional blue-chip stocks of the Dow over the tech-heavy Nasdaq. The shift may reflect concerns over the sustainability of tech valuations or a strategic move towards sectors perceived as more stable amid broader economic uncertainties. For investors, this could signal a reallocation of portfolios towards industries less affected by recent tech sector volatility, potentially influencing future capital flows and market strategies.